Investing your hard-earned money can feel like a giant leap, can't it? You hear about incredible returns, stories of wealth creation, and you want a piece of that financial freedom. That's the power of return. Return is the profit you make from your investments. It's your money working for you, growing over time. This could be through dividends paid out by a company, or the increase in the value of your investment, known as capital appreciation. Think of it as the reward for taking a smart step towards your future. It's the positive outcome you're aiming for, the fuel for your financial dreams, the tangible result of your decision to participate in the market's potential. Now, let's talk about the other side of the coin: risk. Risk, in simple terms, is the chance that your investment might not perform as you expect. It's the possibility that you could lose some or even all of the money you've invested. There are different kinds of risk. Market risk affects all investments when the overall market goes down. Inflation risk means your returns might not keep up with rising prices, eroding your purchasing power. Then there's specific risk tied to a particular company or sector. Risk is the uncertainty, the bumps in the road you might encounter on your investment journey. It's the element that makes some people hesitant, but understanding it is key to overcoming that fear. These two concepts, risk and return, are intrinsically linked. They dance together in the world of finance. You generally can't expect to achieve high returns without being willing to accept a certain level of risk. If an investment promises sky-high returns with no risk, you should be incredibly skeptical. That's usually a red flag. The core challenge for every investor, including you, is to find the right balance between risk and return that aligns with your personal financial goals, your investment timeline, and crucially, your comfort level with potential fluctuations. What works for your neighbor might not work for you, and that's perfectly okay. Your journey is unique. Understanding this fundamental relationship is the absolute bedrock of financial literacy. It's what separates informed investing from speculative gambling. When you grasp how risk and return interact, you're no longer just hoping for the best, you're making calculated decisions. This knowledge empowers you to take control of your financial destiny, to build a strategy that is robust and resilient. It's about moving from a place of uncertainty or fear to a position of confidence and clarity. This understanding is your first giant step towards achieving the financial security and freedom you truly deserve. You are capable of mastering this. So, how do you actually measure if an investment is giving you a good return for the risk you're taking? This is where a brilliant tool called the Sharpe ratio comes into play. Think of it as a performance scorecard that doesn't just look at the points scored, the return, but also how skillfully and safely those points were achieved, the risk. It was developed by Nobel laureate William F. Sharpe, a true pioneer in finance. The Sharpe ratio helps you compare different investments on an apples-to-apples basis, looking beyond just the headline return figure. It's a way to quantify the quality of an investment's performance, not just the quantity of its return. Let's break down how it's calculated, and I promise, it's simpler than it sounds. The formula is portfolio return, risk-free rate, standard deviation of the portfolio. The portfolio return is just how much your investment grew. The risk-free rate is the return you could get from an investment with virtually no risk, like a government bond. We subtract this because you should be rewarded for taking additional risk beyond this baseline. The standard deviation is a statistical measure of how much the investment's returns fluctuate up or down around its average, essentially its volatility or riskiness. It tells you how wild the ride might be. What does a higher Sharpe ratio tell you? Generally speaking, a higher Sharpe ratio indicates a better risk-adjusted return. It means that for every unit of risk you took on, you received a greater amount of return compared to another investment with a lower Sharpe ratio. It's like getting more bang for your buck, considering the potential for ups and downs. A higher Sharpe ratio suggests that an investment has been more efficient in generating returns relative to its volatility. It's a sign that the investment manager is doing a good job of balancing reward with risk, which is exactly what you want to see. Why is this such a game changer for investors like you? Because it forces a shift in perspective. For too long, many investors have been mesmerized by high returns alone, without asking the crucial question, at what risk? The Sharpe ratio helps you look under the hood. It helps you differentiate between an investment that achieved high returns by taking on massive, perhaps reckless risk, and one that achieved solid returns through smart, calculated risk management. It's about understanding the quality of the returns, not just the headline number. This insight is fundamental to building a resilient, long-term investment strategy. Let's make this crystal clear with an example. Imagine you're looking at two mutual funds, Fund Alpha and Fund Beta. Your friend tells you Fund Alpha is amazing because it delivered a 15% return last year. Fund Beta, on the other hand, only delivered a 12% return. Based purely on this information, Fund Alpha seems like the obvious winner, right? Many people would jump to that conclusion. But you, armed with your new knowledge, know that's not the full story. You understand that return is only half of the equation. You need to consider the risk taken to achieve that return. Now let's dig a little deeper and get the missing pieces of the puzzle. Suppose you find out that Fund Alpha, with its impressive 15% return, had a standard deviation, our measure of risk or volatility, of 20%. That means its returns were quite jumpy. Fund Beta, which returned 12%, had a much lower standard deviation of only 10%, indicating a smoother ride. Let's also assume the risk-free rate, what you could have earned in a super safe government bond, is 3% for the same period. Now we have all the ingredients we need to calculate the Sharpe ratio for both funds. Let's do the math for Fund Alpha. Its return was 15%, the risk-free rate is 3%, and its standard deviation is 20%. So the Sharpe ratio for Fund Alpha is 15% minus 3% divided by 20%, which equals 12% divided by 20%, giving us a Sharpe ratio of 0.6. Now for Fund Beta, its return was 12%, the risk-free rate is 3%, and its standard deviation is 10%. So the Sharpe ratio for Fund Beta is 12% minus 3% divided by 10%, which equals 9% divided by 10%, resulting in a Sharpe ratio of 0.9. Suddenly the picture looks very different, doesn't it? The verdict is clear once you apply the Sharpe ratio. Fund Beta, despite having a lower absolute return, 12% versus 15%, actually offered a superior return for the amount of risk taken. Its Sharpe ratio of 0.9 is significantly higher than Fund Alpha's 0.6. This means Fund Beta was more efficient in generating returns relative to its volatility. An investor in Fund Beta experienced a smoother journey and was better compensated for the risk they endured. This simple example powerfully illustrates why the Sharpe ratio is such an invaluable tool. It helps you look beyond the surface and make truly informed investment decisions. The Sharpe ratio is undeniably a powerful tool in your investment analysis toolkit. It provides a fantastic starting point for evaluating risk-adjusted returns, and it has certainly revolutionized how professionals and savvy investors like you assess performance. However, it's crucial to understand that no single metric tells the entire story. Relying solely on the Sharpe ratio without considering its inherent limitations can sometimes lead to an incomplete or even misleading picture of an investment's true characteristics. To make the best decisions for your financial future, you need a more comprehensive view, a broader perspective that incorporates multiple insights. One of the primary limitations of the Sharpe ratio is that it treats all volatility as bad. It penalizes an investment for both upward swings, positive volatility, and downward swings, negative volatility, because standard deviation, the risk measure it uses, captures all deviations from the average. But think about it. As an investor, you actually welcome upside surprises, don't you? A sudden jump in your investment's value is a good thing. The Sharpe ratio, however, would see that positive volatility as contributing to higher overall risk, potentially lowering the ratio, even if the investment is performing well, and exceeding expectations on the upside. Another important consideration is that the Sharpe ratio implicitly assumes that investment returns follow a normal distribution, often visualized as a symmetrical bell curve. In the real world of finance, however, returns don't always behave so predictably. Financial markets can experience fat tails, meaning that extreme positive or negative events occur more frequently than a perfect normal distribution would suggest. When an investment has these characteristics, such as a tendency for infrequent but very large losses or gains, the standard deviation might not fully capture its true risk profile, and thus the Sharpe ratio might not be as accurate or reliable a guide. So what's the empowering takeaway here? It's not to discard the Sharpe ratio. Absolutely not. It remains a valuable and widely used metric for a reason. The key is to use it wisely, understanding its underlying assumptions and its limitations. Think of it as one important instrument on your dashboard, but not the only one you look at while navigating. You should always aim to combine the insights from the Sharpe ratio with other analytical tools and qualitative assessments to get a more rounded and robust understanding of any investment opportunity. Don't put all your analytical eggs in one basket. Diversify your analysis just like you diversify your portfolio. Section 5. Introducing the Sortino ratio, honing in on harmful risk. What if you could fine-tune your risk assessment? What if you could focus specifically on the type of risk that truly keeps investors up at night? The risk of losing money, the risk of your investment's value dropping below your expectations? This is precisely where another powerful tool, the Sortino ratio, enters the picture. It's designed to address one of the key limitations of the Sharpe ratio, by distinguishing between good volatility, which are the upside movements, and bad volatility, the downside movements. It's a more specialized lens for viewing risk, particularly valuable for investors who are more sensitive to losses. The Sortino ratio is essentially a modification or a refinement of the Sharpe ratio. Its genius lies in its exclusive focus on downside risk. Instead of penalizing an investment for all volatility like the Sharpe ratio does, using standard deviation, the Sortino ratio only considers harmful volatility. It measures the investment's return against the risk of not meeting a specific target return, often the risk-free rate or even a zero return, focusing only on the instances where the investment underperforms that target. This provides a clearer picture of how well an investment protects your capital from negative fluctuations. So, how is the Sortino ratio calculated? The formula is portfolio return minus minimum acceptable return, or risk-free rate, divided by downside deviation. The portfolio return and minimum acceptable return, MAR, or risk-free rate, are similar to what we use in the Sharpe ratio. The key difference is the denominator downside deviation, also known as downside risk. This metric only measures the volatility of those returns that fall below your specified MAR. It ignores the upside volatility, the good kind. This focus on only the negative fluctuations gives a more targeted assessment of an investment's performance during unfavorable periods. Why does this distinction matter so profoundly for you as an investor? Because most investors are, quite naturally, more concerned about the possibility of losses than they are about the magnitude of gains above their expectations. While we all love big wins, avoiding significant losses is often paramount for long-term wealth preservation and peace of mind. The Sortino ratio helps you identify investments that might not just offer good returns, but also excel at managing and mitigating downside risk. For those who prioritize capital protection or have a lower tolerance for drawdowns, the Sortino ratio offers a more relevant and insightful measure of risk-adjusted performance. Section 6. Sortino ratio applied. Refining our fund comparison. Let's bring back our friends, Fund Alpha and Fund Beta, to see how the Sortino ratio can add another layer of clarity to our investment decisions. You'll recall that Fund Alpha had a 15% return and a Sharpe ratio of 0.6, while Fund Beta had a 12% return and a superior Sharpe ratio of 0.9. This already told us Fund Beta was better at managing overall risk relative to its return. Now let's introduce the concept of downside deviation to see what the Sortino ratio reveals about how these funds handle specifically harmful risk. Suppose we find out that Fund Alpha, which had a total standard deviation of 20%, experienced a downside deviation of 15%. This means that the volatility related to its returns falling below our minimum acceptable return, let's stick with the 3% risk-free rate as our MAR, was 15%. Now consider Fund Beta, which had a total standard deviation of 10%. Let's say its downside deviation was only 5%. This indicates that Fund Beta was much steadier when it came to avoiding underperformance relative to our target. We have our returns, our MAR, and now our downside deviations. Time to calculate the Sortino ratios. For Fund Alpha, its return is 15%, our MAR is 3%, and its downside deviation is 15%. So the Sortino ratio for Fund Alpha is 15% minus 3% divided by 15%, which equals 12% divided by 15%, giving us a Sortino ratio of 0.8. Now for Fund Beta, its return is 12%, our MAR is 3%, and its downside deviation is 5%. The Sortino ratio for Fund Beta is 12% minus 3% divided by 5%, which equals 9% divided by 5%, resulting in a much higher Sortino ratio of 1.8. Wow, the difference is even more pronounced now. What does this deeper dive tell us? It confirms that fund beta is not only better at managing general risk-adjusted returns, as shown by its higher Sharpe ratio, but it is significantly superior when it comes to managing downside risk specifically, as highlighted by its much higher Sortino ratio. Fund beta provides more return for each unit of bad risk taken. For an investor who is particularly concerned about protecting their capital from losses and achieving a smoother ride with fewer negative surprises, fund beta looks even more attractive through the lens of the Sortino ratio. This is crucial information for building a portfolio that aligns with your risk tolerance and gives you greater peace of mind. Section 7. Expanding your toolkit, other key performance metrics. While the Sharpe and Sortino ratios are incredibly powerful tools for understanding risk-adjusted returns, they are not the only metrics a savvy investor should be aware of. Think of your financial toolkit. The more specialized tools you have, and the better you understand how to use them, the more skillfully you can build and manage your wealth. Let's briefly explore a few other key performance metrics that can provide additional valuable insights. These metrics, when used together, help you paint a much more complete and nuanced picture of any investment's characteristics and potential fit within your overall financial strategy. First up is alpha. You might have heard this term before. Alpha aims to measure the excess return an investment or a fund manager generates compared to a relevant benchmark index like the S&P 500 for US stocks, or the Nifty 50 for Indian stocks. If a fund has a positive alpha, it suggests the manager has beaten the market or added value through their stock selection or timing decisions, beyond what the market itself delivered. A consistent positive alpha is often seen as a sign of skill. However, it's always important to investigate how that alpha was achieved and whether it's sustainable. Next, let's consider beta. Beta measures an investment's volatility or systematic risk in comparison to the overall market, which is typically assigned a beta of 1. If a stock or fund has a beta of 1, it means its price is expected to move in line with the market. A beta greater than 1 indicates that the investment is more volatile than the market. For example, a beta of 1.2 suggests it's 20% more volatile. Conversely, a beta less than 1 suggests it's less volatile than the market. Understanding beta helps you gauge how much market risk you're taking on with a particular investment and how it might behave in different market conditions. Finally, there's R squared. This metric, expressed as a percentage, indicates the proportion of an investment's price movements that can be explained by movements in its benchmark index. An R squared value between 85% and 100% suggests that the fund's performance closely tracks its benchmark. In such cases, its alpha and beta figures are generally considered more meaningful and reliable. If R squared is low, say, below 70%, it means the investment's movements are not well correlated with the benchmark, making alpha and beta less relevant as indicators of performance relative to that specific benchmark. It might suggest the fund is doing something very different from the index. Section 8. The unshakable truth, risk and reward go hand in hand. We've journeyed through some important concepts today, from the foundational ideas of risk and return to the specifics of the Sharpe ratio, the Sortino ratio, and even touched upon alpha, beta, and R squared. It might seem like a whirlwind of financial jargon at first glance, but I want you to focus on the simple, unshakable truth at the heart of it all. You absolutely must understand risk to truly understand returns. These two elements are not separate. They are fundamentally intertwined, like two sides of the same financial coin. Grasping this is key to your investing success. Chasing the highest possible return without a deep consideration of the associated risk is akin to driving a high-performance sports car at maximum speed with a blindfold on. You might get somewhere incredibly fast, or you might experience a spectacular and devastating crash. True, sustainable financial success, the kind that builds lasting wealth and gives you peace of mind, is not about reckless gambling or chasing fleeting hot tips. It's about making smart, informed, and calculated decisions where risk is acknowledged, understood, and managed intelligently. This is how you build an unshakable financial foundation. Think of risk-adjusted return metrics like the Sharpe and Sortino ratios as your financial compass and sextant. They are the instruments that guide you through the sometimes choppy waters of the investment world. They help you navigate towards investments that make logical sense for your individual journey, for your specific financial goals, and crucially, for your personal comfort level with risk. Using these tools helps you construct a portfolio that is not only designed for growth, but is also built to weather inevitable market storms, ultimately delivering sustainable performance over the long term. This is the authentic path to achieving financial freedom. So I urge you, don't be intimidated by these metrics or concepts. Instead, embrace them as your allies in the quest for financial empowerment. They are tools that enable you to ask smarter questions, to look beyond the marketing hype, and to see the true nature of investment opportunities. Knowledge of these ratios puts you firmly in the driver's seat of your financial future, transforming you from a passive passenger into an active, informed captain of your own ship. You have the capacity to understand this, to use this, and to succeed. Believe in your ability to master these principles. Section 9. Important considerations, your financial journey and due diligence. The knowledge you've absorbed today about risk-return ratios is genuinely powerful. It has the potential to significantly upgrade your entire approach to investing, making you a more discerning and confident decision-maker. But always remember an essential truth: information by itself is merely potential power. It's action, guided by wisdom and due diligence, that transforms that potential into tangible results and real financial progress. Your financial journey is deeply personal, shaped by your unique circumstances, goals, and dreams. Therefore, your actions must be tailored accordingly. When you are ready to take the step of investing, particularly in financial instruments such as mutual funds, there are some important procedural and regulatory steps you must follow. One of the first and most fundamental is completing your Know Your Customer, or KYC, process. This is a mandatory requirement set by regulatory authorities to ensure transparency, prevent financial crimes, and protect your interests as an investor. It's typically a straightforward, often one-time process of verifying your identity and address, and it's a standard part of engaging with any legitimate financial institution. Furthermore, it is absolutely critical, and I cannot stress this enough, that you always deal with SEBI-registered mutual funds and SEBI-registered financial intermediaries. SEBI, the Securities and Exchange Board of India, is the chief regulatory body for the securities market in India. Their registration signifies that the fund or intermediary operates under a framework of rules designed to protect investors and ensure fair practices. Before you invest a single rupee, take the time to verify the credentials and registration status of any entity you plan to deal with. This due diligence is a non-negotiable part of responsible investing. Finally, please understand that this essay and the information within it are provided for educational and informational purposes only. The goal here is to empower you with knowledge and understanding. However, this is not and should not be construed as financial advice. Your specific financial situation, your risk tolerance, your time horizon, and your individual goals require personalized guidance. I strongly encourage you to consult with a qualified, SEBI-registered financial advisor. Such a professional can help you analyze your needs and help you craft a financial strategy that is truly tailored to you, enabling you to make informed choices on your path to financial well-being.